Welcome to our comprehensive guide on managerial accounting, where we'll explore three critical areas that drive business success: budgeting, cost analysis, and performance evaluation. Managerial accounting is a vital tool for business leaders, providing the insights needed to make informed decisions, optimize resources, and achieve strategic goals. In this video, we'll delve into the intricacies of creating effective budgets, analyzing costs to improve profitability, and evaluating performance to ensure alignment with organizational objectives. Whether you're a seasoned manager or new to the field, understanding these concepts will equip you with the knowledge to enhance operational efficiency and drive business growth. Let's get started on mastering these essential managerial accounting skills. 1. Budgeting. Budgeting is the process of creating a plan to manage your finances, typically for a specific period, month, quarter, year. In managerial accounting, budgeting helps managers plan and control financial resources to achieve business objectives. Types of budgets. Operating budgets focus on day-to-day operations. Includes sales, production, and administrative expenses. Example: a monthly sales budget and a monthly expense budget. Capital budgets, concerned with long-term investments. Includes expenditures on assets like equipment or buildings. Example: budget for purchasing new machinery. Cash flow budgets track the inflows and outflows of cash. Helps ensure there is enough cash to meet obligations. Example: monthly cash flow projections. Budgeting process. Planning, set goals and objectives. Forecast revenues and expenditures. Prepare detailed budgets for various departments. Forecasting, use historical data and market trends to predict future performance. Adjust forecasts based on changing conditions. Monitoring, compare actual performance with budgeted figures. Investigate variances and take corrective actions if needed. Types of budgets. Fixed versus flexible budgets. Fixed budget remains constant regardless of activity levels. Simple but less adaptable. Flexible budget adjusts for varying levels of activity. Provides a more accurate performance evaluation. Zero-based budgeting, ZBB, starts from zero base each period. Every expense must be justified. Useful for eliminating waste but can be time-consuming. Incremental budgeting based on previous periods' budgets with incremental adjustments. Easier to prepare but may perpetuate inefficiencies. Budgeting techniques and tools. Rolling budgets, continuously updated, usually quarterly. Helps to stay current with changing conditions. Top-down versus bottom-up budgeting. Top-down, senior management sets budget targets. Bottom-up, budget created by department managers and aggregated. Both approaches have advantages and can be combined. Budget variance analysis identifies and analyzes differences between budgeted and actual performance. Helps in understanding why variances occurred and making adjustments. 2. Cost analysis. Cost analysis helps in understanding the costs of producing goods or services and their impact on profitability. Cost classification. Fixed costs versus variable costs. Fixed costs do not change with the level of production, e.g., rent. Variable costs vary with production volume, e.g., raw materials. Direct costs versus indirect costs. Direct costs can be traced directly to a product or service, e.g., direct labor. Indirect costs cannot be traced directly and are often shared, e.g., utilities. Product costs versus period costs. Product costs associated with production and included in inventory, e.g., direct materials. Period costs expensed in the period incurred, e.g., office salaries. Cost volume profit, CVP, analysis. Break-even analysis determines the sales level at which total revenues equal total costs. Formula: break-even point equals fixed costs selling price minus variable cost per unit. Text: break-even point equals frac text fixed costs text selling price text variable cost per unit. Break-even point equals selling price minus variable cost per unit. Fixed costs. Contribution margin represents the portion of sales revenue that exceeds total variable costs. Formula: contribution margin equals sales minus variable costs. Text: contribution margin equals text sales. Text: variable costs. Contribution margin equals sales minus variable costs. Margin of safety measures the amount by which sales can drop before the business reaches its break-even point. Formula: margin of safety equals actual sales minus break-even sales. Text: margin of safety equals text actual sales. Text: break-even sales. Margin of safety equals actual sales minus break-even sales. Activity-based costing, ABC, concept and benefits allocates overhead costs based on activities that drive costs. Provides more accurate cost information. Implementation steps identify activities and their cost drivers. Assign costs to activities and then to products based on their use of activities. Cost behavior and estimation. Cost behavior patterns. Costs can be fixed, variable, or mixed, semi-variable. Understanding patterns helps in forecasting and budgeting. Cost estimation techniques. High-low method uses the highest and lowest levels of activity to estimate variable and fixed costs. Scatterplots, visual method to analyze cost behavior. Regression analysis, statistical method for more accurate cost estimation. 3. Performance evaluation. Introduction to performance evaluation. Performance evaluation assesses how well an organization or individual meets its objectives, using various metrics and tools. Key performance indicators, KPIs, financial KPIs. Profit margins measures profitability, e.g., gross profit margin, net profit margin. Return on investment, ROI, measures the gain from investments relative to their cost. Non-financial KPIs. Customer satisfaction, metrics like Net Promoter Score, NPS. Employee turnover, measures employee retention. Performance measurement tools. Balanced scorecard provides a comprehensive view by evaluating financial and non-financial aspects. Includes perspectives: financial, customer, internal processes, learning and growth. Benchmarking. Comparing performance against industry standards or best practices. Helps identify areas for improvement and set performance goals. Variance analysis. Analyzing the differences between actual and budgeted performance. Helps in understanding reasons for variances and making informed decisions. Management by objectives, MBO, concept and implementation. Setting specific objectives with measurable outcomes. Aligning individual and organizational goals. Performance reviews. Regularly reviewing progress toward objectives. Adjusting strategies as needed. Performance reports and dashboards. Types of reports. Financial performance reports include income statements, balance sheets. Variance reports show differences between actual and budgeted figures. Effective reporting techniques use visual aids like charts and graphs. Ensure clarity and focus on actionable insights. Recap of key points. Summarize the importance of budgeting, cost analysis, and performance evaluation in managerial accounting. Highlight how these tools aid in planning, controlling, and improving business performance. Importance of managerial accounting. Emphasize its role in strategic decision-making, cost management, and performance enhancement.